Okay. So with notes, there's sometimes we have to do adjusting entries with notes as well. And we did this in college accounting procedures sometimes, but we might just not have understood why we did the adjusting entry. So hopefully this will help with some of the adjusting entries we learned in college accounting procedures. So say we issue a note December 1st, and it's a 60-day note. Well, we're issuing it in 1 year. Say we issued it in 2019, December 1st. That note's going to come mature. They're going to pay us in 2020, this year. But we issued it last year. So what happens is we need to calculate any interest that we have actually earned in 2019. We haven't gotten it yet, but we've earned it. It's revenue. So any revenue that we earned in 2019 has to be recognized in 2019. That's the revenue recognition principle we learned last semester. So what happens is if we have a note that's written in 1 year and we get paid the next year, at the end of the first year, we do an adjusting entry to recognize any interest revenue that we've earned and haven't received, okay? So let's look at an example. That makes more sense, right? So it says, assume that Crawford Company issues a $4,000 90-day 12% note dated December 1st, 2013 to settle its accounts receivable. If the accounting period ends on December 31st, then we have to recognize any accrued interest, any revenue that we've earned in 2013 that we just haven't received yet. Okay, so this is accrued revenue adjusting entry. So our issuance of the note is the same. We debit notes receivable and credit accounts receivable for the face value. Then at the end of the current year, well, we calculate 30 days have passed, right? 31 minus 1 day. 30 days of interest has accrued on this note. So we've earned 30 days worth of interest on this note. They're going to pay us next year, but we need to recognize the revenue that was actually earned in the current year. So we do an interest calculation, which as you notice, it's the same as the one on the board. It's still face value times interest rate times time. The thing that we look at is just the days that have passed in this current year. So we take 4,000 times the 12% times the 30 days in December divided by 360. So we've earned $40 worth of interest in the year 2013. So this is our adjusting entry. Good old adjusting entries, right? You thought you were finished with them. We debit interest receivable because it's interest owed to us that we haven't received yet. And we credit interest revenue. So we're recognizing the revenue in the year in which it was earned. Revenue recognition principle. Okay. This is only when the note goes over 2 different years. Okay. Any questions on that? Yes.
Why are we multiplying 30?
Good question. So we're doing the 30 days just for the interest that has accrued in this current year. So since the note was issued on December 1st and it's now December 31st, we took 31 minus the 1st to get 30 days. If it had been issued on like November 1st, then we would have to, account for November, the 30 days of November as well. Good question. Any other questions on that? Okay. And then when this actually gets received on March 1st, when the note matures, the company that owes us is going to pay us the full principal and the full interest. But we've already recognized some of the interest revenue, so our journal entry to receive the payment changes just a little. So we received cash, $4,120. So that's the full interest, the 12% at, was it 120 days or whatnot? We still credit their notes receivable for the face amount of $4,000. We credit interest receivable because they're now paying us the $40 we already recognized last year. The total interest was $120. So if we've already recognized 40, we need to recognize the remaining 80. So the total interest is 120. 40 of that we've already recognized. So 120 minus 40, we have remaining interest revenue of $80 to recognize. Another way to look at it is this total note was 90 days, so the total interest is $120. Well, we recognize 30 days worth, which is $40. So then we would just calculate 60 days in the current year. So from January 1 to March 1st was 60 days. 60 days worth of interest is $80 of revenue.
So in the first one, is it like, because we haven't got the interest yet?
Correct.
Okay, I thought that was saying we had received it. That's why it's
Yes.
receivable.
Yeah, we didn't actually receive it. It's due to us. That's why we put it in interest receivable. So yeah, that's where it gets a little confusing. So last year when we did the adjusting entry, they hadn't paid us any interest because the note hasn't matured yet. So we're just like, oh, it's due to us. So we put it in a receivable account. And then when they pay us this next year, that's when we actually receive the full cash.
Okay.
So they're paying us the full cash. But that $40 we've already put in interest revenue, right?
Yeah.
So we just credit interest receivable to show they're now paying us what they owed us from last year. So they're paying us, for them, nothing changes. You know, they're paying us principal plus interest. We just have to recognize the revenue in the correct years in which it was earned. Make sense?
Is revenue a credit account?
Yes. Yeah, revenue will be
that's why we're
credited.
crediting it.
Uh-huh. And interest receivable is getting credited because now we're receiving it. So we debited it when it was owed to us, and we credit it to zero it out.
Okay.
Yeah. Any other questions on that one? It's the tricky note. It's the only tricky note. So we have like 10 minutes. So let's just finish up this last example, so then we'll be done. It's not as bad as it looks. So. Okay. So this is an example where we have a note that's over 2 years. So in 2017, we have the following transactions. On December 7th, we received from Unitarian Clothing and Bags on account a $75,000 60-day 3% note dated November 7th. So that first journal entry, when we issue a note, we're issuing a $75,000 note on account. So what do I debit and credit just to issue the note? Very good. We're going to debit notes receivable and credit accounts receivable. Very good. And that's for the face amount, the $75,000. Face amount is $75,000. On December 31st, again, this note is not going to be due until February 5th, so of the next year. So on December 31st, we need to calculate how many days have passed and account for the accrued interest. So on the 31st, this was issued on the 7th. So how many days of interest do we need to recognize? 24. Very good. 24 days in 2017. Okay, that's how many days of interest we need to calculate in 2017. So 31 is December 31st minus the 7th, 24 days. So we just follow our same format though. 75,000 times 3% times 24 divided by 360. Very good, $150. So our interest, as our adjusting entry that we need to recognize, is $150. Okay. So again, we're going to debit interest receivable and credit interest revenue, $150.
So these are both going up because that's debit and credit account.
Yes. Yeah, interest receivables increasing and revenues increasing. Yeah, right. You got it. So we're just recognizing interest that has accrued that we haven't received yet. It's an accrued revenue. Then if there's a fun one at you, what's the closing entry? What? No. Remember, revenues get closed into income summary in the closing process. That's a nice review. Remember, all those expenses and revenues all get closed and dividends at the end of each year. So just know, interest revenue to close it, you would debit it to zero it out.
Oh, it's like the opposite of,
Yeah, you did the opposite of its current balance, and we close that into income summary. You won't have to know that on the test. It's just a nice, throw a good review at you. And then on the due date, when this note matures, we want to recognize the full payment. So when they pay us, we have 24 days out of the, what was it, a 60-day? Yeah. So then in 2018, well, we recognized 24 days, so 60 minus 24, we're going to recognize 36 days of interest. Okay, 75,000 times 3% times 36. Okay, going to be 225. So this is how much interest is due or receivable in the current year. 60 days total. I just add these two up to get my total interest on the note. So 375 is total interest. So when this note matures on February 5th, they're going to pay us cash the maturity value, principal plus interest. So 75,000 plus 375 in interest. So 75,375, 75,375. Notes receivable still gets credited for the face value of 75,000. 75,000. Well, we're now receiving this 150 of interest. So we're going to credit interest receivable for 150. 150. And then we're going to recognize the additional interest that we haven't recognized yet, the 225, as interest revenue. So my total debit is 75,375 equals my 3 credits, 75,000 plus 150 plus 225. So $375 is my total interest. 150 of that we already recognized as revenue last year. So we're going to recognize the remaining 225 in revenue. And they're paying us the full amount. Any questions on that? Okay. Well, again, you'll practice it on the homework, so that will help, kind of practice those concepts and get that down. Okay.